Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, with my co-host Brian London. He's actually in Atlanta this week. And we have Otavio Costa from Crescat Capital, based in Denver. He is also going to be present at the New Orleans Investment Conference coming up in a few months. So Tavi, he is the man for macroeconomic events, and there's so much disentangle right now. Welcome to the show. Thank you for being here. And please tell us, how can we interpret a smash or crash in precious metals when inflation is at decades long highs?
Well, it is a little bit suspicious, the level of the sell-off and how it turned out to be on Sunday. However, stepping back and looking at the broad picture of the macro scenario we have today, gold and silver are really signaling this inflationary forces back. It was the first side of the commodities market that began to really move up. You remember oil prices went negative in April or so. And so gold and silver really, and the miners began to really signal this move in cyclical commodities ahead of us. And then after that, after elections or so, was really when this whole move in commodities really intensified. So I think that a lot of the gold and silver market were pricing in the risk of at least an attempt of the Federal Reserve to start tapering. And I think that the Fed, the latest jobs report gave a green light for the Fed to do that. The question is, can they sustainably tighten or reduce the level of liquidity in the markets today? And I believe strongly the Federal Reserve is trapped. And that's what it goes back to, this idea where we may see inflation expectation continue to run hotter than not only 10-year yields and long-term treasuries, but also hotter than other alternatives of investment. And that's when you want to own tangible assets. And that's where it comes down to, is the ownership of something that not only allows you to protect your capital, but also to grow sustainably. And I think there's a lot of ways and a lot of opportunities to expose yourself to that thesis.
Tavi, Brian here. As we're talking, I'm not sure when this is going to air, but we're really talking about that Sunday night flash crash. And it was preceded on Friday by a big sell-off in gold, but that seemed to be more, fundamentally or news-oriented and excusable because we got a fairly positive jobs number for July on that day. But the Sunday night crash was obvious manipulation. There's no way that anybody picks the thinnest of thin trading days to sell at the market and in such size as to guarantee the worst price, unless they're actually shorting gold and then reversing those trades to bottom. So it was at the least high frequency traders, and at the worst, some other manipulative actions by other actors, governments or otherwise. But regardless of that, it was, and all of this environment, as you say, is anticipating, it's speculators who are looking for the next Fed announcement, which would be some form of tightening, rate hikes, possibly tapering or the like. And historically, whenever we've actually had this kind of situation and the Fed begins to hike rates, those speculators tend to, having bought the rumor, sell the news, and it releases that selling pressure on gold, and we have a good rally. December of 2015, we had a 6-month rally in gold, and that really marked the bottom of the long bear market in gold. You think that's going to happen this time, or will it, rhyme a bit and happen a bit differently?
Well, what I think is that we're sort of in a vicious cycle in the markets as a whole and the business cycle as well, and where the Federal Reserve starts to fight inflationary forces, obviously very late to the party. And usually that creates a financial shock at some point. And that financial shock is immediately accompanied by progressively larger monetary and fiscal stimulus that then feeds on a much larger inflationary thesis. And I think that that's what, leads to long-term inflationary problems that we haven't had since the 70s or the 40s or the 1910s. There are plenty of examples throughout history where you can go back and see the performance of assets that have done well during those periods. So that's the way I see it. I think the recent jobs number, gave us, it scares me a little bit of what could happen with treasuries, and if the Federal Reserve really will attempt to do that. But can you attempt to do it? In other words, taper the purchases. I mean, there's no real buying of treasuries. I mean, today we saw supposedly record demand for an auction of treasuries, in creating some rallying forces for those securities. However, on the long term, we clearly know that a lot of central banks are not net buyers of treasuries at the moment. If you look at real rates across the globe, especially in developed economies, the U.S. has one of the worst real rates we've had, especially core CPI relative to yields of long-term treasuries. And we all know CPI is extremely underreporting what the real inflationary forces are. So what concerns me about this is yes, I think there is a risk of yields in the short term to rise. And if that happens, I think that could create some financial shock, especially in regards to leadership of the market with tech companies and some other very high multiple names that have been really able to justify those valuations due to really low cost of capital. So I'm a believer that we're going to see a comeback of fundamentals and especially the prioritizing margins and profitability again. So bottom line improvements rather than top line improvements, where we've been seeing that among a lot of the tech companies rather than the profitability idea. So I think there's a lot of changes in the dynamics of leadership in the markets that we're about to see from this. But again, it all feeds in that vicious cycle that at some point we see the Federal Reserve not being capable of doing what they're trying to do, which is sustainably taper, sustainably tighten the market, which at some point also feeds into this inflationary thesis. Nothing is the end of the world. There's a lot of things that you can do as an investor here, but you got to be aware of those dynamics, in my view.
That brings up a great point, among other good points that I've been really curious about is the gap between the market's inflation expectations as measured by TIPS break-evens. And on that rate, we have negative real rates of about negative 1.1% or thereabouts. But if you use the CPI, the actual real-time measured rate of inflation, then at least at the short end of the curve, real treasury yields are on the order of 5% negative on a real basis. And that rivals anything we saw in the worst era of the 1970s. So what's that gap? Is that just the fact that the bond investors are believing the Fed and that they're going to have it under control? Is it that the fact that the Fed is the big elephant in the room buying all these treasuries, so is tainting those readings a bit? Some combination thereof. I mean, it just seems to me that once the market, if we can get a reading where the market starts projecting inflation of 5% going forward, then we can have a real, rally in the metals, as people start seeing that and then positioning and allocating back toward the metals.
Yeah. Why is there that glaring disparity between the like you said, the TIPS break even or the TIPS expectation versus what we're actually seeing measured?
Well, there's a lot of reasons for that, I think. But one of them, in my opinion, first of all, I think that the only buyer of those TIPS in a huge way has been really the Federal Reserve, which now owns about 20+% of that market. In my opinion, they are doing that in order to really attain control over a market that at some point, if it does get out of control, they're capable of doing this. The market really is buying into this transitory idea in a way, which I think it's a lot more persistent and allows a lot of investors to perhaps position themselves in a different way, where perhaps this move of inflation will be more persistent. And I think it will. I think that there's a lot of reasons to believe in that. The structural changes in wages and salaries is number one. The changes in globalization, the continuation of suppression of interest rates. Everyone talks about the mandate of the Federal Reserve. Well, anyone with the brain looking at the data knows that the Federal Reserve shouldn't be doing 120 billion of QE and rates at zero in order to get the markets back in terms of full employment, where we have a lot more job openings than the amount of people unemployed. At the same time as we have inflation already well above their target. Regardless if you're looking at average 12-month inflation, today's inflation relative to their target. So the only reason that would perhaps justify those actions would be the suppression of interest rates, which I think it's clearly what's happening here. That's the real mandate of the Federal Reserve, in my opinion. That will continue to be the case. I mean, there is no way. It's like I kind of make a joke about us going back to the 70s and saying, well, let's just hypothetically here, think about what if inflation is a little bit more persistent and it starts running into the system. As we all know, it feeds on itself and it really becomes and builds on its own over time. Let's just say we do have something like that, like we saw in the 70s and the 1910s. What would the Federal Reserve do? Raise rates, shock the world and raise rates by 2%? It can't even do that today. So it's tough to see the Federal Reserve becoming sustainably hawkish. And that's why, in my opinion, the real rates point that you put out, you just discussed at the beginning of your question, is the whole reason why, or one of the main reasons why I think investors should be allocating capital towards tangible assets. I don't think it's always the case that you should be buying commodities, buying gold and buying silver. Obviously, there are some insurance ideas where you want to hold some of your portfolio in gold. Now, there are real moments when those assets, especially the ones that are miners and that you take up a little bit more risk, where you can be more aggressive into your exposure to those assets, where it makes a lot of sense at times where we are right now, suppression of rates and having to allow the economy to run hotter than it's supposed to. So that is why we're so excited about, looking for ways of expressing this view into the commodities market, which I think is one of the most important ones. It's insane. I mean, commodities to equity ratio still is at one of the lowest levels in history. At the same time as we've seen all these policies and the likely continuation of those policies going forward. So I'm really excited about this. We have bubbles everywhere. Every asset class is in a bubble, the equity markets, the treasury market, the housing market, but the commodities market. And so I believe this is all a lack of capital allocation that will shift. And I think that capital appreciation towards those assets, we're going to see in a very long and sustainable way going forward.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, this is Brian London with this week's CEO interview, in which we interview the CEO of one of the companies in the Inventa Capital Group, with Inventa Capital being the sponsor of the Gold Newsletter podcast. I'm speaking right now from a hotel room in Las Vegas, speaking at a conference, and Charles Funk, CEO of Heliostar Metals, is with us this week, symbol HSTR, on the TSX Venture Exchange. And Charles, I know you've just come back from a conference. People are just getting back into in-person conferences. So we're out there spreading the story, you spreading the gospel of Heliostar Metals, me spreading the gospel of gold in general, but Heliostar being one of our top recommendations in Gold Newsletter. Just put out some news on Heliostar on the Unga project in southwestern Alaska, where you continue to expand on previous results and finding more gold. Can you catch us up a bit on the news that you've just put out?
Yeah, thank you, Brian. Literally just walked in the door, and it was nice to be able to talk to people face to face about these results. We've hit a third gold zone on the property. We've hit economic intersections in every target that we've drilled at Unga. These results show two zones of mineralization at Aquila over 220 meters. Headlight being, 1.5 meters at 10 grams, another 3 meters at 6.5 grams. So just scratching the surface of a third gold zone.
Yeah, and that's what, to refresh and catch people up, The Unga project has been explored by a number of other, I guess, fair to say, undercapitalized companies before. You don't have that problem. It has suffered, the project has suffered before from sporadic exploration, a hole here, a hole here, raising money, another small scale exploration program. You're really hitting it hard and consistently and comprehensively according to a plan, and learning the structures as you go along, drilling holes where you understand where the structure is and not necessarily drilling holes for the market. That said, you are hitting gold in just about every hole. Where you're expecting to hit it now?
Yeah, the cool, well, two things to go back to your first point is this is a huge property. Like it's twice the size of Manhattan Island. And as you said, it's hardly been explored. We've drilled 10,000 meters in the last 12 months. That's as many meters as got drilled in the previous 28 years. And that highlights how underexplored the project is. And so with such a big project, we talked about how do you approach that with these high probability targets. And it's nice to tell you that we've hit gold on these high probability targets. So our integrity as geologists remains intact. We hit those bonanza results at Apollo earlier in the year, the 3 meters at 88 grams. That's open, and we've got to come back with a diamond drill rig. And now the same applies at Aquila. So the concept was the 2 RC rigs that we brought to site did what you could call framework drilling, where we roughly flesh out the dimensions and we can get lots of meters quickly. But one of the negatives is you can only get down, say, about 100 meters below surface on average, sometimes a touch deeper. And so this year was about fleshing out these new zones, particularly Apollo and Aquila. And then next year we'll come back and we'll then step down. And if we're lucky and it continues to hang together, then we can add them to a resource. So that's the idea of that methodical exploration that you talk about. And the cool thing is now we should have a good flow of results with, as early as this week, we should have an update on some more results. We've got results more from Apollo, more from underneath the resource to follow up this extension at the Aquila discovery. And then we put a couple of holes in a porphyry target we think is pretty interesting as well. And so they'll be pretty soon as well.
Oh, wow. That sounds interesting. I haven't heard about that before. But let's don't overlook the resource. This is an exploration story, but it's really an expansion story as well, because there is a resource, a large scale resource at pretty phenomenal grades.
Spectacular grade. So there's 384,000 ounces at 13.8 grams. With a market cap of about $20 million, you're completely backstopped in your valuation, and you just get this free ride on all these different targets where we're hitting. And we know that our big picture goal is lifting to that 1 million ounces as step one, because there's a huge re-rating if you come with a resource in that order of magnitude. It's extremely high grade. It's in the US. It's easy to permit and develop. There's not many projects with this much upside and this much security in what we have.
Yeah, great point. It is an extraordinarily high grade resource. What a great starting point for an exploration story, because everything else from here, like you say, is essentially free, every ounce of gold, because your current market cap, you're undervalued on the basis of that resource that you have already. You just have to clear a certain hurdle of size before that resource will be developed. I think it's probably there already at some level of development. But if you hit that 1 million ounce mark, which, considering you have so many other targets that you're drilling right now, seems very, not just possible, but probably probable, then all of a sudden big companies have to take notice, and the economics just really start to sing at that point, especially at those kinds of grades.
Yeah, you couldn't have said it better. Security of ownership and grade of resource. Can you ask for anything more in investing these days?
So in closing, tell us a little bit about this porphyry target.
Yeah, so our focus is clearly on these high-grade veins, but anyway, it's a system with a lot going on. So there was a target in the 70s that had 107 meters at 0.4 gold equivalent from surface, and there's not a drill hole within 400 meters. So we went back and stepped out and have just put a couple of holes in that. We think that there's many ways to win on Unga, and this is just one of those shots. So when you get big porphyry targets, we know what it did for companies like GT Gold that pivoted from high-grade gold to porphyries. we're still strongly and dominantly focused on the high grade, but it made sense to put a couple of holes in, and we should have those results very soon.
Well, we'll be looking, Charles, results constantly coming out, a lot of RC drilling being done, so a lot of holes coming out, hitting gold, as you say, with every hole where you expect to. That's gratifying, of course, and more to come. So we look forward to an update very soon for more results.
Perfect. Thank you, Brian. Thank you, everyone, for listening.
Tabby, I'd like to explore in a moment or two some specific ideas you have on how to take advantage of that. But going back to what you said, how the Fed cannot raise rates, can't take or raise rates appreciably. Can you explain why that is?
Well, first of all, it's the levels of debt. But the second answer for that, and we can talk about two things. There's two dynamics. Number one, there's short-term rates. Short-term rates cannot rise mainly because of risky assets, I would say. A lot of risky assets are using that as a way of measuring those very high multiples we have in equity markets and so forth. The long-term rates are also related to that, but even more related to the government debt situation. And so government debt is at levels we haven't seen before. And that's why it creates this idea that perhaps we're going to see debt monetization. And I think we're already seeing forms of that, with the Federal Reserve being the largest buyer, the buyer of last resort. Now, there's another thesis here that I think it's also important, which is the cost of capital. Cost of capital has allowed a lot of companies that are highly leveraged to really survive in this macro environment. I don't think that they would. A lot of companies, a lot of industries would have had a lot of trouble being at the position that they are today if this was back in the 70s when cost of capital was 3-4 times the size of today. So I think there's a lot of issues. We all remember what happened with corporate bonds. Remember the junk bonds market literally a year ago, during the whole pandemic problem, where the Federal Reserve had to step in while interest rates barely rose at those times. And so I think that those are all dynamics of how liquidity could really dry up in those markets, and forcing the Federal Reserve to continue to be, the buyer of last resort and providing liquidity in a way we haven't seen before. So that progressively larger packages of stimulus from the fiscal and monetary side is what sustains the markets at this valuations as a whole, and allowing them to lever it up the way we're seeing. So I think those are the reasons why it's difficult. Well, can they? The question I ask myself: if you're trapped, wouldn't you try to take any option to try to exit from that situation? Of course you would, and that's what the Federal Reserve is doing. They know they wouldn't be able to raise rates or taper sustainably over time. But if the market gives them an opportunity to do so in the short term, they will try to do it. Why wouldn't they? And so that's why I believe they gave it a green light. But the word that is really should be emphasized in this: can they sustainably do that and over time? And so I highly doubt that that's going to be the case, and why I'm so bullish on other things such as base metals, precious metals, even energy commodities as well.
Doesn't the Fed really want inflation so that it can, to give it the room to raise rates at least moderately or behind the rate of inflation, so that inflation can depreciate the value of that debt?
That's a good question. And I think it does, perhaps not in a way that we've seen, recently, which became the prevalent narrative everywhere. And folks begin to really talk about inflation, which we saw recently in the last 3 to 4 or 5 months. And then maybe this last month, it kind of died out a little bit with the correction in commodities as a whole. But I think that's not necessarily what they want. They want something, kind of understated, which is something they've been doing in terms of the CPI numbers being well below what we think the real inflation is. Our calculation is it's at least double digits from where we were a year ago, or even 24 months ago. Taking away all the base effects that a lot of folks are concerned about. And so I think, to answer your question, I do think that the Federal Reserve wants some level of that. Now, we may see what we saw back in the pandemic of 1919 Spanish flu, which was first we saw the supply issues, just like today. And the second portion of that was that 1 out of 5 folks in the labor market at the time was engaged in a protest related to work. And so folks are demanding higher wages and salaries as cost of living started to rise. So that is not what the Federal Reserve wants. Obviously, inflation hurts everyone, but first and foremost, the bottom 50% of the population and the lower classes. And so as long as that narrative doesn't get out of control, I think that's all within the Federal Reserve's, ideally, how they would like it to be. So this transitory propaganda that we've seen so far, which may turn out to be true, not what I believe, but some folks really think that that's possible. I think that is in a way a propaganda to kind of calm down folks from what's happening. What worries me for just a second is that policymakers, especially politicians, are discussing this issue as the root cause of inflation being the lack of infrastructure in the space in the U.S. And I'm sorry, I don't believe in that at all. I think the root cause is a lot of other things. It's the pillars, all the pillars of inflation we have. It's starting with the money printing and the fiscal stimulus and the helicopter money policies, with the supply issues that some of them have nothing to do with the pandemic. Some of them were supposed to happen over time, given the fact that commodities and the infrastructure developments that we've seen in this space are actually in a declining trend for over a decade. I mean, we all know CapEx for producers in commodities in general have been declining. It's nothing to do with the pandemic. This is a fact that has been happening for a while, a secular decline. The difficulty of finding labor market to drill a property. You can't find not only equipment, but someone to actually do the job. It's difficult to find that. And so there's a lot of reasons why inflation is higher, and that's nothing to do with the actual infrastructure in the economy and the need for more bridges and all that. And I'm not saying that we don't need those things, but that's not the root cause of inflation. So we're probably, in order to fight the issue, we're going to stimulate even more, inject more liquidity. And I think that's what really makes this about. The fiscal stimulus has nothing to do with the pandemic. It has to do with a much bigger agenda of inequality, of climate change, of electrification. And I don't think that's going to end anytime soon. We're going to continue to see those policies going forward. Sorry for the long answer.
I love the answer. It's everything that I've been saying recently or over the last few months, and put better than I ever did. So, and it's really interesting how the definition of transitory, which initially was a few months, and now it seems to be morphing into a few quarters. And pretty soon we're going to see just a couple of years of this. It's kind of like, 2 weeks to flatten the curve kind of a thing, and moving the goalposts all over the place. And, Peter Bookvar had a great commentary today on the new CPI numbers, in that he's always been saying service industries are really helping to drive that. Wages will help drive that. But one of the things that's really missing, and it's 30% of the calculation in the CPI, in the headline CPI, and 40% of the core are rents. And that we're seeing in the early indications, the early data, we're seeing double-digit inflation rates, annual rates on rents. And we're still getting that reported in the CPI as just fractions of a percent. So that's coming down the line and will help boost all of that.
Yeah, I think that's true. I think there's a lot of issues in regards to rents that usually lag the price appreciation in the housing. Mm-hmm. And to your point about transitory, there are ways. There's a sort of a fight of narratives within the macro community of, is this the 70s? Is this the 40s? 40s being an example of something transitory. And to your point, when in the 40s as an example of supposedly something that will be transitory here, well, back in those days, inflation stayed above 5%, which is kind of where we are today, 5.4, 5% on the CPI. Over two years in those two times that we saw back then. And so even though it was supposedly transitory, would the equity markets really be capable of attaining this a market where inflation really shoots up to 20+% or so and stays there for about above 5% in about 2 years? I think we would see a lot of big shifts in the markets in general if we see something like that. I think it's sort of I mean, in my opinion, it's really a mix or a merge of the two times, really. I mean, you don't have the leverage, issues. We didn't have the leverage issues in the 70s. That was certainly not a problem. The Federal Reserve was capable of moving along with the inflationary forces, was capable of really taking this monetary policy to another level as far as volatility. I mean, it really moved along with inflation. We had a much more repressive financial system back in the 40s, which resembles a lot today. In the 40s, we had the amount of debt. Now, the things that are different from the 40s, first of all, from policy making standpoint, I would say a lot of politicians at the time, and you can read that in books and statements of those times, they were much more aware of the situation of inflation today. Today, they think that the root cause of inflation has to do with the lack of fiscal stimulus in a way, and so there's a lot of changes in terms of that. Look at the tax policy at the time. The tax policy for the top 1%, I'm sorry, the highest tax bracket of those times was about 90% relative to where it is today at about 37%. Or at the bottom 50% also, if you looked at the lower tax bracket, was twice what it is today. So there's a lot of difference, even from valuations, that doesn't allow the Fed to really move and become even more repressive than it was in the 40s. So again, long answer again, but I think there's a lot of things to be concerned about this idea of inflation building on its own for longer than most believe.
And we've seen a lot of talk recently just of this word stagflation coming up. Now, we know you're this macro man. Are we going to see also halted growth in the United States? What is the prediction for that? So are we going to see both this elevated inflation and weak growth?
So as background, I would say that stagflation doesn't usually, it's much more cyclical than long-standing, number one. At least that's what we saw throughout history. It doesn't mean we may see a structural change on that as well. But I think that starting from the growth side, it's very possible we are going to be entering a stagflation environment in the next 12 months. My belief in that is especially due to first of all, the fiscal overhang from the prior year. Number one, I think there is going to take a little bit of a shock, a financial shock, even some deterioration in the economy to lead to further monetary and fiscal stimulus. And I think we're going to go back to that path again very soon. Like I said, I don't think this is about the pandemic. I think we've seen this issue of the dependency of fiscal and monetary policy for a while. But historically, the economy is booming, right? In the last 6 months, we've never seen anything like this as far as, and no kidding. I mean, we saw so much money printing on top of the fiscal stimulus. Obviously, that will create a level of activity in the economy that we haven't seen before. And so here we are at a very hot economy, while the Fed continues to print 120 billion a month on top of zero interest rate policies. And a lot of things are still in place, and we just passed an infrastructure package here. But I do think that the economy will decelerate a bit here. I think I think that would be very normal, and especially in regards, and usually inflation is a little stickier than usual, I would say. And I think that will create a stagflationary environment for a bit. Until we see monetary and fiscal stimulus coming in again at a point where the economy runs hot again, and then they're going to have to fight inflation. So we're in that vicious cycle, and some of the parts of those cycles will get into stagflation. And so I think that the next 12 months, there's a very high probability stagflation will be the environment. And we may see even a little bit of a below expectation as far as inflation in the next 1 or 2 reports. And a lot of folks will be saying, oh, this is all transitory. I told you so. And then things go back to that upward trend again. And will surprise a lot of people, in my opinion. And that's when we enter that stagflationary environment, in my view.
But you're talking about a lot of monetary policies that will greatly benefit gold and silver, of course. You've also mentioned that some of the supply disruptions out there aren't the result of the pandemic. I think one of those examples, primary examples of anything, is copper, where we've had at least a decade long underinvestment in capital expenditure has led to supply constraints just at the point that we're seeing a very a pronounced steepening of the demand curve. So that's one of those areas, but it's across the board with a lot of commodities. One of the things I've also noticed is that Crescat Capital, your firm, has gotten very active in the mining sector. Can you explain what you're doing now, what kinds of opportunities you're looking at right now or think are the best? And you're actually getting a bit activist, I've noticed, in some of your investments as well.
Well, thanks for allowing us to share a little bit what we're doing. I think this all falls into this macro thesis of owning tangible assets. And when I believe that there's going to be a continuation of the policies that we're seeing today, perhaps not to the degree that we saw in the last, since the March crash and all that, I think there will be a continuation to a very higher level of the dependency from the Fed and the government to continue to prop up liquidity here. At the same time, we're seeing supply issues, not only from a geological challenge of finding commodities as a whole, but also from a lack of spending or investments in the space for a real long time. That may change, but people forget that mines take, as you know, Brian, this takes ages to be developed. A lot of those mines in a good environment, you may take 5 years. In a normal environment, that may take 10 to 15 years to really develop a mine anywhere in the world today. And so there is a miscalculation from the government of this green agenda in regards to what we think a lot of those commodities as far as demand to get there. So the road from the old economy to the new economy, I think commodities is right in between, which allows us as a fund to start acting on this. So number one, if you are long tangible assets and you believe that those are going to be outperforming other assets, you can just buy those assets, or you can buy the large producers. That's another idea. You can be a royalty company. You can buy a lot of the royalty companies. And I think a lot of financially savvy guys are really participating in the developer market of companies that are developing mines, already have a discovery of a certain commodity. And that's also a very interesting strategy. But for us, we believe there's a depletion of assets of the major companies that will create a demand for new exploration developments or new exploration projects that will be purchased by those companies. We haven't even seen that part of the cycle yet, which I think it's ahead of us, of the M&As that we're going to see with the major companies, with the junior companies that have very highly economical and viable projects in different parts of the world that will be able to become and advance those projects to become actually producing mines. And so our focus has been, well, if we think that there's sort of a floor, we don't know if there's a floor in prices for metals in general, but we think there is some of that given the macro and the macro factors that are in place today. And so allows us to take a little more risk than most people, partner with a geologist, first of all, perhaps the most intelligent and successful exploration geologist, Quentin Henney, to really pursue a strategy where there's really not a lot of folks and capital allocators really buying into the very left side of the Lassonde curve, as we like to say, the exploration names, the very small cap names, where we can take a very long-term mentality approach and really purchase a lot of assets in that space. So we've participated in over 90 deals, and some of them, obviously not all the 90 deals, are activist plays. We also buy into purchasing assets that are high quality assets with good teams. And so they can run those companies on their own. Now, we like to have a very high level of participation in terms of being activists and helping them on the financial and geological side as much as we can is in a few core positions in our portfolio. And great example of that would be SK Mining. We've helped Laurel Resources in Bolivia in a lot of ways. Newfound Gold has been a very successful one that we've been involved since prior to IPO. Defiance Silver would be another one. We're very involved. New Legacies, another one. There's plenty of names. I was going to say Firefox in Finland is another one. Novo Resources. And so there's a lot of names, and some of them are more in the developing and beginning of producing their own commodities they're working with. And in case of Novo Resources, as an example. So I think there's a lot of things to do here to perhaps take advantage of this environment. So we're really excited. We want to build and invest and be involved with the new discoveries that we're going to see. There's a lack of discoveries of gold and silver and copper in the world. And we want to participate on the new discoveries, be the ones invested in the new discoveries that will come along, and perhaps really be capable of bridging the majors that are going to be looking for those assets, high quality assets, and us really being the ones funding those deals at the very early stages, 5, 10, 20 million market caps that perhaps could become 400, 500, 600 million companies and become attractive for those folks that want to buy them and turn into multi-billion-dollar companies. So that's the focus with Crescat at this point.
Okay, mate. Well, Tavi, we ran through the half hour there. Your Twitter is just Tavi Costa. That's Tavi Costa, and I just followed you myself as we began the show, so I should have had you on before. And his company is Crescat Capital. I don't know how you pronounce it correctly. And yes, he will be at the New Orleans Investment Conference coming up in October. So that's neworleansconference.com. Otherwise, all the show notes will always be at goldnewsletter.com/podcast. Tavi, thanks for your time and have a great day there in Colorado.
Thanks for having me.
Thanks,
Beautiful.
Tavi.
Cheers.
Thank you.